Well, welcome to Chapter 2. Chapter 2 is kind of just an intro to financial markets. And so it's very big picture about the various financial markets that the U.S. has. You can see the big topics we'll cover right there in that slide. So let's kind of get into some of the nuts and bolts then of the chapter. So first of all is how is capital transferred between borrowers and savers? So three options: direct, investment banks, or financial intermediaries. Direct is two parties just getting together. I used to work for an insurance company. We did a lot of investing, a lot of investments, and companies would approach us directly to say, would you invest in something for us? And whatever that would be, we'd listen and potentially do a deal. It cuts out the middleman, makes it a little bit cheaper. An investment bank, companies that go public, that issue stocks and bonds, they hire an investment bank to work them through the process. And the investment bank is an expert. They take on some of the risk, manage the risk, and help that company go public or issue bonds for the first time. And then financial intermediaries, just think of your bank, your credit union. Obviously, if you kind of think about what banks and credit unions do, they want depositors. They want people to put money in the savings account, to buy CDs, to do various investments with them. And they take the money that's been deposited with them, they turn around and they take a portion of that and loan it out as credit card loans, car loans, mortgage loans, whatever it may be. So just kind of keep that in mind. That's what they do. So, but the point is that we've got ways that borrowers and savers, users and demanders of capital can easily find each other and efficiently exchange funds. So the quicker that happens, the easier it is for that capital to flow between the two parties, the more efficient the company or the economy is. So that's a big deal. In the U.S., under the capitalistic-based economy that we have, that's a big deal, that efficient allocation of capital. The better that is, the better it is for society. If that was difficult to do, then prices would go up. It'd be harder for companies to finance inventory or build buildings, and everything would go up. So just know that more efficient the capital allocation process is, that makes the economy more efficient, keeps prices down, and so on. So we all know what a market is. If you would stop at Hy-Vee, your local grocery store, gas station, that's obviously a market. I stop in, there's something for sale. I exchange my money for that item and I go on my way, right? So we know we've got physical markets. We also have virtual markets, and it can be no different for us as individuals. We can all easily order something on Amazon, or you name the website, it'll get delivered to us, right? So we know that we can virtually buy things also, and it's no different in finance. So a market is just really where individuals or businesses get together and buy and sell to each other or trade to each other. And in finance, we have markets that do the same thing. You can see some of the various markets are right here, and we'll go through a little bit of each one and go from there. So well, I thought we were going to do that right here. So let me do that right here. So financial versus physical assets versus financial assets. Now keep in mind, in finance, a lot of the things that we are investing in is represented by a piece of paper, right? It's just more of a document, an online document. I put money into a 401k, a mutual fund. I buy a stock. I buy a bond. I buy a CD, things like that. I have a loan. I buy a stock. It's all more of a financial asset that doesn't really have a physical shape or form besides maybe printing out a document. So kind of keep that in mind too. Now you can invest in real estate, jewelry, art, antiques. Those would be physical assets. Spot versus future. Spot is buying something today. When you walk into the grocery store and buy something, that's on the spot. Farmers, commodities dealers, they can sell something based on a future. I'll sell you grain 6 months from now at this price. And the farmer maybe doesn't even have that grain planted in the field yet. So something like that, a futures market. Money versus capital. Money is short term. So when you hear about money market fund or a money fund, that's short-term investments. Capital is stocks and bonds, which are more long-term. Then primary versus secondary. When a company first goes public, they call that an initial public offering, IPO. That's a primary offering. So if a company goes public brand new, Uber and Lyft are good examples of companies that have recently within the last year at least gone public. And when they first went public and sold that stock, that was a primary offering. Today, if you were to buy some shares of Uber or Lyft as an investment, that's the secondary market. You're buying stock from somebody else who's already bought it. You're not buying it directly from the company. Then public versus private. Publicly owned just means we can get on a stock go to a broker, an online broker, and buy stock of a publicly owned company. A publicly owned company just says, I'm asking the public for money. Invest in me. And of course, there's regulatory things we have to go through to do that. But private just means doing a private placement. And companies can do those as much as they want. They can do private placements, just basically saying, we want investors, we're looking for private investors to invest in us or lend us money or whatever that might be. Okay, but the chapter will give you a lot of good info about that too. And I've mentioned a lot of this information that the more efficient that our markets are at matching users and suppliers of capital to each other, the more opportunities are to invest and so on, increases the efficiency of the market and makes basically our way of life better. So a derivative, when you think of the word derivative, think of derive. Its value is derived from something else. And so derivatives, as I mentioned, the ones we can think of the most are commodities, oils, grains, things like that. And commodity prices fluctuate a lot, but you can do derivatives on all kinds of things. You can make derivatives based on stock market ups and downs, interest rates up and downs, and so on. But essentially, they're used as a measure to hedge or reduce risk. The example would be if I think the stock market will go up and I make investments based on that, but then I get a little worried that maybe it's not going to go up, I can make some investments thinking if the stock market goes down, I'll be okay. And you can make investment decisions based on what you think the market's going to do in the future, up or down. So if I feel like the position I'm taking is maybe not going to happen the way I want, I can take a counter position and then hedge or reduce my risk. So that's just one example of that. And then there's all kinds of examples of financial institutions. The one we can probably think of a lot would be some kind of a commercial bank or credit union. There's private equity funds. If you've heard the name Bernie Madoff, that was a private equity fund that did not go well. And we'll talk about some of these in future classes. Depending on where you work, if you work for the state of South Dakota or some kind of a government position, you probably have a pension. A lot of people have a 401k where they work as retirement. That means you're putting money aside and putting it into a mutual fund of some sort. An exchange-traded fund is also called an ETF. It's an investment that matches the stock market return. If the market goes up, your ETF goes up and vice versa. So stock market transactions, and what this one does, it talks about Apple, and it says here, Apple decides to issue some additional stock. And if we bought some of those new shares of stock, obviously Apple's been public for a long time, but quite often companies will say, well, we're going to raise some more money, we'll issue some new stock. That's not unusual. And if Apple were to do that, and we bought some of those new shares, that'd be a primary transaction. But if I just wanted to buy Apple stock, and Apple in reality has not done that, but if I wanted to buy Apple stock today, I could log into my brokerage account and place an order and be buying Apple stock from some other person who wants to sell, right? So that's a difference between a primary and a secondary transaction. So an IPO is when a company goes public for the first time, initial public offering. And this is a great slide because it shows how the S&P 500 is done from 1968 until basically 2017. And 2018 was a pretty good year. 19's been up and down so far. But take a look at what you see here. And the blue is anything that's above zero. And the ones that are kind of white below the zero line are the losses. But I want everybody to see is that the years that were positive far outweigh the years that were negative, by far. Now, if you remember a few things back in history here, we had 9/11, 2001, that caused a recession. We had 3 years consecutively of stock market going down. Then we had the recession of 2008, where the market lost about 40%. It actually had lost 50% of its value at one point. It ended the year at a 40% loss in value, and it took 3 years. And the good news is 9, 10, 11 were all positive. and the market came back and was, by the end of 11, the market was where it was at the end of 2008. That's good news. But I just want you to see that there's way more positives than negatives. Okay, so that's one thing to keep in mind. And also, the historical average of the stock market over the last 75 years, the average return is 8%. Okay, but that means you can have years that are negative. You can have years that are below 8%. You can have years that are above 8%, but the 75-year average is 8%. And then look up a stock. My favorite website to use is finance.yahoo.com, just Yahoo Finance. By far, that's the one I like to use the most. And you can just see here, all you have to do is go to Yahoo Finance, just Google it, and just type in, once you get there, just type in the stock name, like Twitter is TWTR. But you can just type in Twitter itself. You don't have to type in the actual stock symbol. It'll find it either way. And then this kind of just shows you some key information about Twitter on that particular date and time. And obviously, we could find the most current date and go from there also. So stock market efficiency, keep in mind that in the internet age, we live in a world of high information. You know, you can have your phone set up to give you all kinds of push notifications, and somebody's going to, you know, some website you follow, some app on your phone is going to keep you up to date on all kinds of things about the news, sports, finance, business, whatever it would be. And if you want to look up a stock, it's not hard. It will not take you long to log on to an app or a website on your phone and find the information. You can make stock trades easily on your phone. Every major stock market brokerage firm has an online app that you can use to make trades. I think everybody, I would imagine, has whatever app their bank has to manage your finances. It's no different. So the key is that the market is efficient. Information is transferred quickly and efficiently in the U.S. because of the internet and cell phones and all that kind of stuff. And so the goal here is it's not easy to beat the market. Okay, so the goal or the takeaway is, because we have a highly efficient stock market, information travels quickly. For the most part, it's hard to beat the market. Now, small companies that are not tracked as much, that are still publicly owned, they're just not as nationally known, sometimes if you hit those at the right time, before they go crazy and go big, you can make some money that way. But if you're investing in the big, well-known companies, it's harder to beat the market. So that's just one small takeaway. We'll talk more about the market in future chapters too. So they kind of just give us an example here. If you have the news on, you hear some company just got FDA approval to sell one of its products, can you quickly buy the stock and make money? And the answer is, well, no, because everybody knows that, right? And a lot of people who follow the company knew that was in the pipeline and knew what the odds were of the FDA approving it and so on. So it's really hard to beat the company. And also, IPOs are very risky. When a stock first goes public, there are many examples of IPOs that did not go well. Uber would be a good example of an IPO that did not go well. Facebook, believe it or not, was an IPO that the stock price was below its IPO value for a few years before the stock finally shot up. So there's many examples. So my general recommendation is you don't buy a hot IPO stock. You buy a stock of an established company and go from there. Now, one of the last topics of the chapter is behavioral finance, and they talk here about making good decisions and making rational decisions. And I would dare guess that we've all made irrational decisions, right? Especially when it comes to our money. So unfortunately, because we are emotional beings, we don't always make rational decisions, especially when it comes to our money. So while the markets are very efficient and the transfer of information is very efficient, the downside of that is that we make irrational decisions as investors. So that does muck up the efficiency of the market a little bit because people make decisions about that. Now, nowadays, a lot of investors are using AI and bots and algorithms to make trades, which obviously would increase efficiency and take away the ability to make bad decisions, unless you've got a bad algorithm or whatever. But that's kind of replacing what people decisions are quite often now a lot of the bigger finance companies are trying to automate that as much as they can, because that eliminates the human side of making a bad decision. There's good and bad to that, obviously, but just kind of be aware of behavioral finance. Okay, so that was chapter 2. As always, if you have questions, just let me know. Thanks.